Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning. This is Quincy Krosby. This is The Talking Point, and it is Monday morning, August 22nd. Thank you so much for joining me. I appreciate it. This is, again, another very busy week for the market. And the reason is very simple. It is Friday morning, 10 o'clock Eastern. That is when Jerome Powell will give a speech at the Jackson Hole, Wyoming meeting where central bankers from around the world attend. It is a time, it's a venue in which he can, if he chooses to, offer his ideas, his opinion on where inflation is headed, the trajectory of inflation, and perhaps shed some light on his views regarding the next rate hike. Now, I want to make it very clear because he made it very clear at the last Federal Reserve meeting. He said, we do not want to telegraph where we are going in terms of the amount of a rate hike, whether it's 50 basis points or 75 basis points. We want to be data dependent and we want to steer the rate hike, and it will be a rate hike, obviously, but we want to steer it where we believe the economy needs it, depending on the data. Now, also remember that we don't have a Fed meeting this month in August. It's coming in September 20th and 21st. And there will be a number of inflation-related data releases before then. In fact, on Friday morning at 8:30 Eastern, before Chairman Powell speaks, they will see the Personal Consumption Expenditure Index. That is the PCE, which is supposedly the Fed's preferred measure of inflation. So he will have at hand that data release, if not before then. Sometimes I wonder if the Fed is actually seeing data released before, but we know how they changed course after seeing the Consumer Price Index and the University of Michigan's Consumer Sentiment Report. And they were in the blackout period, and boy, we had been told basically from the Fed a 50 basis point hike was coming. And during that blackout period, just a few days before the Federal Reserve meeting, they changed course. And it came because they saw the data just as the market saw the data. And we had the 75 basis point move. So in any event, the hope is that there is some clarity from Chairman Powell, not necessarily saying, 50 basis points is on the table. We're talking about 75 basis points. But where does he see inflation headed? What's the trajectory? Is it coming down fast enough? Do they think it's plateaued? Something along those lines would be very helpful. So the market is kind of waiting and seeing and wanting to hear something a little bit more specific from the chairman. Now, keep in mind that after the last Fed meeting, and that was a meeting in which the market decided he's getting a little bit less hawkish. He's getting perhaps a little bit more dovish. But we heard from one Federal Reserve speaker after another. It was an orchestrated, synchronized parade of Federal Reserve speakers telling the market, we are going to keep going until we believe we have reached price stability. And remember, price stability is one of the Fed's mandates. The other mandate is to create an environment of sustainable economic growth, which, by the way, is the labor market, to bring the market, the economy to full employment. So in any event, Friday morning is it. But 8:30 Eastern, we'll get the PCE, and that is going to matter. It'll matter very much. Apparently, Christine Lagarde, the head of the European Central Bank, will not be there, although she will be, I think, coming out with a paper or a speech before Friday. So we'll hear from what she has to say regarding the ECB's next move. Remember, they raised rates 50 basis points, and they are looking at inflation in the eye. So the market, as everyone knows, has been a little bit skittish. In fact, last week, the only sectors that moved up were, how about this, consumer staples and utilities. Hardly the kind of sectors that you would see if you believe that we were in the clear. Now, also remember, the Fed can enjoy the fact that we have a strong labor market. Now, granted, they don't want to see wages as sticky as they are. In fact, not just sticky, but climbing higher. And I want to go over why. Because what we know is that when wages climb higher, companies, obviously, they're going to pay the wages, but they have to raise prices. And as long as we are prepared to accept those higher prices, companies and services, right? Not just companies manufacturing something, but they're going to go ahead and raise those prices. It's called a wage price spiral if it becomes entrenched. And that's the most important thing for the Fed. They don't want to see anything entrenched. So in terms of the broader inflation picture, we know that rents, while they're easing and they're leveling off in many parts of the country, they're still high. And it represents about 30% of the consumer price index. So there's a lot for the market to have to digest until we get to Friday. But I think it's going to be a cautious market and a market hoping for some more guidance from the chairman of the Federal Reserve. There's an awful lot of data that the market will also factor in this week. But before I get there, I want to mention that, we're closing in on the end of the second quarter earnings season. And 78% of the companies beat analyst estimates, which is well ahead of the long-term average. That said, it's coming down a bit. And there are expectations that for Q3 earnings, that is going to be weaker still. We came into the second quarter and it was, it's going to be terrible. It's going to be horrible. Pessimism everywhere. And it didn't turn out that way. Guidance has been mixed, but, for companies doing well, the guidance has been strong. Top line revenue growth has been strong. And the bottom line has been fine. Operating margins have also maintained their strength. So it is almost stock specific, is it not? And that is, this kind of market where not everything goes up altogether. So we're paying very close attention to that. This week, we're going to start off with today, that's Monday, with the Chicago Fed National Activity Index. This is important. By the way, last week we had the Empire Fed Survey, which is New York. It includes parts of Connecticut and New Jersey. In terms of manufacturing, it was terrible. And then we had the Philadelphia Fed Survey, and I may have mentioned this on this call. The Philadelphia Fed Manufacturing Survey is more in line with the rest of the country, especially the manufacturing hubs. And that surprised to the upside. And that was good news, extremely good news for the market. So tomorrow on Tuesday, we're going to have what we call a flash report. These flash reports, by the way, are really preliminary reports until the final report comes out. And this will be for the Manufacturing Purchasing Manager Index as well as the Service Sector Manufacturing Index. It will not come from the Institute for Supply Management, the ISM. Rather, it will come from the S&P Standard & Poor's global reports. So keep that in mind. The ISM is the standard, the one that we have always been following, but it has been joined by another survey company. And it's still very important. A lot of folks watch it. But again, this will be a preliminary flash report. And then we will have new home sales. This is going to be interesting because we know that the Fed's rate hikes have slowed down the housing market. Cancellations are up, and they are up mightily across the country. And what does that tell you? It tells you that folks are becoming increasingly careful. Again, something the Fed wants to see. They want to dampen consumer spending. They want to dampen the economy, because that's the only way for them to see that inflation will come down on the demand side. On the supply side, that's something else. And we're seeing a mixed picture. One of the reasons is China. China suffering now. They've had the stringent zero COVID measures shutting down the economy. But now a major heat wave is slowing factory production, factories that have come back online. So, they're still a major supplier in the global supply chain. So this is the last thing we want to see. Also in Germany, that has a major port that is crucial for the global supply chain movement across the world. That has slowed down, very hot weather, and also threatened of strikes. So we're watching that. Again, it's not what we want to see. But all told, I just want to point this out, the global supply chain problems are easing. The challenges are easing. We're not there yet, but we're getting closer and closer. And why is it important? Because it helps to bring down prices, right? That's what we're looking for. So if we get closer and closer to prices coming down and inflation coming down, maybe meeting together, it will be extremely important to telling us that we are finally conquering the higher prices wrought by supply chain shutdowns and also higher prices in the U.S. And then on Wednesday, a very important report is the durable goods order. This has within it a report on what are companies paying, what capital expenditures. We know companies are being increasingly careful. In fact, a recent survey from chief financial officers, the majority believe we're already in a recession. So they are being careful. So we want to see, are they spending on technology? Because we know companies don't want to shut that down. That is the future for them to save money when they do invest in technology upgrades. And then we'll get pending home sales. And then, of course, on Thursday, initial jobless claims. I do want to report that the last report showed that that was coming down. Now, the average American would say, hey, that's really great news. But for the Fed, they want to see a slowdown in employment, all the barometers and measures of employment. Why? Because they want those wages to come down. And because, again, to repeat, they don't want to see a wage price spiral becoming increasingly entrenched. And then we will also have a read on gross domestic product. So we'll see that. And, that's a series that we see. And by the way, I do want to mention, especially after we've had 2 straight quarters of negative growth, that right now the Atlanta Fed GDP report, which moves, it takes in data every single day. Right now, it is suggesting that we will have a positive GDP for this quarter, which of course is not over, but so far, so good. It's not astoundingly positive, but it is positive so far. And then, as I said, on Friday, we're going to have the PCE report. To repeat, it is the Personal Consumption Expenditures report. Normally, by the way, this report tends to have a better picture of inflation. That is to say, a little bit lower inflation. On some of the healthcare inputs, they tend to be weaker than what we see in the CPI. Also, in terms of travel, ticket prices tends to be lower in the PCE report. So we'll see what it has to say. Again, it comes out at 8:30 a.m. Eastern. Chairman Powell on Friday will have this report before he speaks at 10 o'clock Eastern at Jackson Hole, Wyoming. We'll also have real disposable income and a number of variations on that. And then again at 10 o'clock on Friday, 10 o'clock a.m., as the chairman is speaking, the University of Michigan's Consumer Sentiment Report. And within that report, it's the final report, we will see how U.S. consumers feel. The previous report, which was the flash report, it was the report that comes before this Friday's report, showed that consumers are actually feeling a bit better. And clearly, the fact that gasoline prices are beginning to come down has certainly been a help for consumers. But we'll also see where they see inflation over a 5-year period. On some reports, we've seen it ticking up. So what we want to see and what's needed is to see that coming back down. And we did see that in this report, but in the flash report, it ticked up just a bit. So it's a busy week for all of the above. The Fed meeting, or rather Chairman Powell's report on Friday, and also all of these data releases. Now, I also want to mention this week in terms of earnings. There's a little bit left over. This is what I'm watching. Please pay attention to it. It's Nvidia. Nvidia is one of the major semiconductor names. It is in everything. We know Nvidia because of gaming, but it has moved into other parts due to mergers and acquisitions, other parts of the semiconductor landscape, and especially in automobiles, right? Everything in the automobile is chip related. It's somewhere. By the way, even in your toothbrush now, there's a chip somewhere if you get one that has a battery or you have to plug it in. But the reason it's important is the semiconductor index, whether it is the Philadelphia Semiconductor Index, the SOX, or there are other variations of it, are important precisely because semiconductors are in every aspect of the economy. We want to hear what they're saying. We want the guidance because it tells us when the economy is picking up, because demand picks up for the semiconductors as the economy turns. So I'm paying very close attention to what Nvidia has to say this week. Thank you all very much. Please don't hesitate to get in touch. Take good care, and we'll be back again next Monday after we have heard from Chairman of the Federal Reserve, Jerome Powell.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.